Hi, I'm Max Keiser. This is the Keiser Report. I wonder what we're going to be talking about today. Let's find out. Talk with Stacy. Stacy, what are we talking about today?
Well, we're talking about Ponzi schemes because there's been a big Ponzi scheme that was, unveiled last week in America out of Hollywood, of all places. And so I'm just looking at the psychology of this and how Ponzi schemes continue to operate, whether on an individual scale or all the way up to the central bank level. And here was the first tweet I saw in my stream the day that this broke last week, midweek, and is blowing my mind that this quasi-rando was able to raise $227 million from investors for a scam production company when there are literally hundreds of real indie producers struggling to get real movies made. How are investors this stupid? This was an actor called Zach Avery, 34, who was arrested last week. And in fact, the Ponzi scheme was $690 million, but he managed to, he was paying off previous investors with new investors. So he managed to get away with $227 million that he failed to pay back. But if you look at that headline of here's this Ponzi guy, how did he raise $690 million when real production companies with real products don't get made? Just like in our economy, where real manufacturers, real wealth producers, real content creators, they don't get anywhere. Whereas those who are fictional, fake, pushing a dream, have no actual income stream, zero revenue, in fact, huge losses, those get valued more, right? So we're going to explore that.
Well, we're heading for the digital singularity.
Yes, you mentioned that before.
And so this is a good example of it, because why, the idea of meat space, where you go and hire actors and shoot films and then edit the films, and it takes a lot of time. There's development costs, and there's producers, there's editors, there's all kinds of support. There's craft services. They got to feed people, right? And that's all from the 20th century, 19th century. We're in the digital event horizon has been crossed, and people understand that in the digital world, you don't need any of that meat-based stuff. You don't need anything analog. It's all digital. So having a digital representation of a fantastical, non-existent movie production sold to non-existent viewers in a non-existent area of planet or Area 51 is perfectly fine in the minds of many. And so hundreds of millions of dollars are raised and lost. But remember, all money that's lost, whether it's a fantastical Ponzi scheme film sales company or that hedge fund that just blew up with that credit. Archegos. Remember that the central banks will immediately replace the cash immediately with no questions asked, right? Because their cost of capital is zero, and they consider everything systemically important, whether it's a Ponzi scheme in Hollywood or a hedge fund, Archegos, it doesn't make any difference. They're all systemically important in the minds of the fiat money printers, and people understand this, and they may have lost everything in this Ponzi scheme, but they might make it all back in another Ponzi scheme. There's nothing that's not a Ponzi scheme.
Partly because the individual has a very amazing imagination. That's what humans are blessed with, but also cursed with. If you actually see the drudgery of producing sausages or producing Hollywood films or manufacturing cars. That's why automobile manufacturers who actually produce tens of millions of cars a year are valued at way less than those who don't produce that many cars a year. It's the imagination of what could possibly happen. Now, in this case, the headline in the Daily Mail read that D-list actor Zach Avery, 34, is arrested for masterminding $690 million Hollywood Ponzi scheme and forging Netflix and HBO licensing deals to fool investors. So his Ponzi scheme was exactly what I used to do for years, work in film sales. And he claimed that he managed to raise $690 million for alleged film sales that he was doing just to Latin America, which was our tiniest market. We did film sales outside of the US. So the whole world outside of the US. Latin America was the entire region. You sold the film project to all of Latin America in one deal. Instead of you don't sell it to all of Europe, you sell it to France, Germany, Spain, all the countries. So that's the tiniest market of them all. It's a puny market. It's hardly any money. So how anybody thought there's anything in Hollywood that could make $690 million in Latin America. But you also need huge debts. Like that's why our company ended up like after 15, 20 years going bankrupt, because you get a lot of money up front, but you keep on having to service the film for years and years and years with promotional materials, recording box office, like chasing various distributors for the money that they're owed and blah, blah, blah. So it's a huge amount of cost. So like the people who got defrauded from this were not individual, like ordinary investors. They were hedge funds and stuff like that you would think would do due diligence.
Right now, in this environment, the more fraudulent something sounds, the easier it is to sell, and the higher the possibility of making a quick buck is. So the standard now for an investment is how fraudulent it sounds and how fraudulent it is. Most hedge funds engage in wholesale fraud. Like Warren Buffett's a famous guy for making investments, but he got bailed out several times because he was engaged in illicit activities. So the more illicit, the more fraudulent something is, the greater it is, the easier it is to attract capital. If you have an actual business, like you're a Girl Scout selling Girl Scout cookies, you're going to get thrown into the bin of trash bin, because who wants to actually engage in something that's real for somebody who's real that might have a real future? But if you can throw money away at a fantastical, non-existent, nonsensical Ponzi scheme in a heartbeat, you'll do it, because there's the chance that will make a great profit, and you can just invest in 20 or 30 of them, and one of them is going to hit.
And we've often talked about how the entire fiat-based, debt-based global economy is based on the Ponzi scheme. And you can see it in that sort of behavior. As you mentioned, that any company with real cost of producing their product, they get really penalized in this economy, because who wants human labor cost or parts cost? Like anything, the more fictional your business model is, the easier it is to raise capital. But it's also like the whole structure of the scheme. So here he managed to pay off like over $300 million to previous investors by taking in new money. And many say that's how our whole system is based, whether it's Social Security or indeed the entire bond market, right? So since 1981, interest rates have been declining for over 40 years. So you have the rolling over, new investors paying off old investors. And then you're at the point where, like, as all these schemes unravel, you have to either like create these fake letters from Netflix and HBO, which is what this guy did, this D-list actor, Zach Avery. He was, when his investors were complaining why he wasn't paying them their monthly payment, he said, he fabricated letters saying that they were the ones, that HBO and Netflix were slow in paying him. Like how they didn't notice that these products weren't being distributed in Latin America, I don't know.
No, they noticed it. That's what made it appealing, because it's obviously a fraud. So there's no films there's no letters. In the case of the bond market, there are no bonds. That's what a negative interest rate is. There's no bonds there. Now we've got a multi-billion-dollar NFT market, non-fungible token market, in the so-called art market, where there's no art. There is no original art. There's only copies, which can be copied infinitely with absolute fidelity. So there's no original art, and there's only copies of the art, and there's no original art. But now it's a multi-billion-dollar industry. Obviously a Ponzi scheme, obviously a fraud. But now it's a multi-billion-dollar industry, as is this Ponzi scheme, as is the bond market, as is the fiat money. You have to grade possible investment opportunities on the level of potential fraud. If it's very, very high, then it's a must-do. If there's actual people involved with real jobs making real stuff, stay away, because the possibility of doing anything profitable is zero. The only exception being Bitcoin was kind of calling time on this whole thing, and that's why it's so high in price, but more on that later.
Right, and the equivalent in the fiat debt bond world of fabricating these letters of proof of like somebody owes you money is the Fed buying the treasuries. So quantitative easing, like buying up all the debt, it's like that's like fabricating supply, like demand. Like there's no actual demand for any of this debt.
It's like freeze-dried water. Just add water. Right? It's like an NFT, non-fungible token. It's art. Just add the art. Here's the token for $100,000. All you need is the art to go with it. But you got the token, just you don't have the art. Just add art. It's freeze-dried art. It's freeze-dried bonds. It's freeze-dried productivity. It's freeze-dried money. It's sold as if it's something in a can. They just need to add what it is that it says it is.
Yeah, again, the Ponzi-like nature of it, as long as people continue to believe it and you can keep on finding new investors, that's, whatever, you can keep it going. And when the Fed chairperson comes out and does their Fed speak, that is a fabricated letter as well. That's a fake letter. They're telling you everything is okay. Keep buying. We need new investors to roll over this
Right.
debt.
But are these people making an investment if the cost of their investment is zero? Because that's the interest rate the Fed is offering. Can you really call that an investment? If you say, I'm going to buy a non-fungible token for $60 million with the money I borrowed from the central bank that cost me nothing, is that really an investment? Or is it money laundering? Or what is it exactly other than a Ponzi scheme? And exactly that's what it is.
Yeah, I think it's a Ponzi scheme. I'm not sure how many people, it's like people, they keep on being able to flip it. You keep on being able to roll over your bond. There is always, for 40 years, there has been a new chump to come along. So at a certain point, you forget where it came from, that it's not real. And you feel like it's real. It feels like there's demand, allegedly. So you feel like, maybe this is all great. Like these hedge funds probably would have kept on rolling over this debt and giving this guy more money as long as he kept paying the interest every month and kept, making principal payments as well. Then it's like they don't ask questions.
Okay, so why is Bernie Madoff in jail?
Well, because once it stops, that's the problem. If the central banks can't keep the scheme going, if people totally lose faith in it, for example, you mentioned the 30-year, Greece just sold some bonds at a lower interest rate than America is able to get right now.
Oh, it's much better credit than the United States. They've got tons of olives there. They've got more olives in Greece than in America combined. All 50 states, we don't have the same number of olives that they have in Greece. That's why they're able to borrow money cheaper than the United States of America and Greece. Makes sense.
Well, again, this fictional, if it's all in your brain, if it's all in your mind, if you just imagine that Greece might not go declare bankruptcy once again.
Oui, je suis Christine Lagarde. Je suis le chef de SCB. Et Grèce, c'est de monnaie pour les bonnes, c'est moi aux États-Unis. Parce qu'il y a beaucoup d'olives en Grèce. Oui, Christine Lagarde, je suis chef de SCB. Je suis génial. What a clownfish. That woman needs to be seriously re-educated about how economies work, or she needs to be sent to a olive picking plantation in Greece. We're going to take a break, and when we come back, much more coming your way. Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to our conversation with Rick Ackerman of rickackerman.com. He's a former market maker, and he's also a stock picker and a newsletter publisher. Rick, welcome back.
Thanks for having me on, Max.
All righty, Rick. Let's finish up what we were talking about, inflation versus deflation. We've been talking about this for a few years. I think the breakthrough for me on this conversation, listening to you again, and you've been right about this now for years, where a lot of other people have been wrong, in that you've been really saying the dominant theme here is deflation, is the fact that, and we'll touch on it now again, you say, okay, it's one thing to reflate stocks and to boost stocks and to buy bonds, but when the pension system starts to collapse, like we're seeing in Illinois, and presumably that'll spread to other states, that's a deflation of a whole nother magnitude. Can you pick up on that and talk a little on it?
Sure. I think you need to look at deflation as a process by which many zeros are going to disappear from the ledger. Anybody who's owed dollars is not going to get paid those dollars. And of course, there's a whole sort of daisy chain there of other people who get paid once you get paid. So those zeros will be wiped off the books much more quickly than the Fed can conceivably replace them. And I often go back to the Weimar hyperinflation of the 1921, 22, 23. As an example, it was a completely different kind of inflation in that the German government was literally sending out boxcars filled with money so that the employers would not have riots on their hands when payday came and they couldn't pay their workers. So you can toss out the Weimar hyperinflation, and also the fact that it was hyperinflation in a local currency rather than in a global reserve such as the dollar. So the dollar edifice, as it were, is so huge that it cannot possibly be pumped back up when it reaches that critical threshold of implosion.
Right. So when you're talking about the debts default faster than the money can be printed, I mean, you're talking about, so debts default. When you say disappearing zeros, you're saying that pension funds will simply default. They won't pay. They'll go bankrupt. And in response to that, there won't be enough money printing to fill the gap. It'll happen. I would imagine that once it gets going, it happens with a great speed. For one thing, and there's a compression of the crisis. Instead of a rolling default that we've had for 20 or 30 years, there's, I guess, do you see a capitulation at some point where people realize, you know what, this is the end, none of it's going to get paid, let's just default, and it's a different phase of the crisis, Rick?
Yeah, I think it's going to happen so quickly, really, that people will have to acknowledge it in the way that you've just said. You know, with respect to Illinois, we're talking about literal helicopter money to kind of counteract that. It would require the federal government to send out pension checks to 2.6 million, let's say, Illinois retirees. The checks would vary in size from $500 to $2,500 a month, perhaps. So obviously, when they start doing that, New York, California, Connecticut, and 20 other states are going to come there with their hands out looking for the same bailout. And you can understand that it can't go very far, because if the federal government gets into that area of bailing out with literal helicopter money, that would be a hyperinflation. And of course, the Illinois guy who gets $2,000 check, that check won't even buy a bag of groceries if the government is bailing out everyone else. And also keep in mind, whenever I use the word government in terms of the government's going to do this, it's going to bail this out or bail that out, I think you have to substitute the word taxpayer to understand that the money, or at least the promise of money, has to come from somewhere.
So what do you call it when you see prices? You're seeing cost push, right? Inflation. You know, prices of stuff are going up. The commodities are going up. Prices are going up. Health and education and other costs are moving up. So people are feeling that the purchasing power of their dollars are decreasing. So what do you call that? If that's, how do you position that within within a deflationary picture, right? Well, what do you call those costs that are going up that people notice? Because they're in purchasing power for the dollars not going up. So they're not feeling the deflation, right? They're feeling inflation. How did they manage to get to two of the worst things going simultaneously?
Well, you know, the people who've argued the inflation side have been cheating for years and years and years by not specifying what kind of inflation we're talking about. And they kind of want you to believe that it's a 1970s inflation, which was, I think you could call that an organic inflation. It was a wage push inflation. The wage earner was never quite catching up with increasing prices, but it did have as its basis higher and higher paychecks. And that in part drove inflation. But we're not really talking about that at all. You can see where the 1970s inflation could just keep going and going and going and going. In fact, it did until it met Paul Volcker. But in this case, it's not that kind of inflation at all. It's really just an asset inflation with, let's say, moderate inflation in the lettuce bin, you know, our grocery bill and fuel and things like that. But you can see where the things that are most inflated are not sort of going and going and going and keep on going. They are in bubbles that could implode, and that is pure deflation. So we don't have anything like the 1970s inflation. We've essentially got an asset bubble.
Okay, so in the 70s, you had wage inflation. And this was still an era of organized labor when you had the ability to organize wages. And that was, of course, was dismantled by Ronald Reagan. We don't have wage pressures anymore, particularly since we outsourced all of our jobs overseas to Asia, to China in particular. So what you're saying is that within this deflationary big picture, you've got asset bubbles. So these are bubbles that when they pop will add to the deflationary pressure. I guess is what you're saying. Now, let's talk about something here. Again, we've been talking about it for years. Let's revisit it. And that would be gold. According to your latest comments at rickackerman.com, which is an excellent website, by the way, I've been visiting it for years. I think you're in the camp of it's so hated at this point that as a contrarian play, you might see some juice here. Rick, is that what's going on?
Well, I'm recommending what I would call a barbell strategy on the inspiration of a friend of mine, a financial advisor in Boulder named Doug Bainfield. He's done very well by his clients since the 1970s, since the 80s, by sticking with bonds. And he's had phenomenal years, a little bit of decrease in interest rates on the short end of the curve gives you enormous capital gains if you're out there 10, 20, 30 years in bonds. So I like gold versus bonds right now as a barbell. Everybody hates them both. Bonds are in such a horrific bear market. It's hard to see the end of it with the federal government talking about $2 trillion, $2 trillion stimulus packages and things like that. So I really like gold and bonds. And I think if you sort of extrapolate the logic of a deflation or even a hyperinflation, you're going to do just fine in one or the other. I think you're going to do well in both of those investments.
Right. Yeah. That you couldn't pick two less attractive, less favored investments right now. And of course, that is the key in many times in finding winning opportunities, because you have to go really where the crowd is not, right? So the crowd is one point, and so the idea being that any gains have been picked over pretty good because the crowd's been there for a while, and they've certainly hit into the tech stocks, have had a terrific run in terms of Tesla, which is really a poster child for tech stocks now for a few years. You have had an opinion on it off and on for a few years. It's around $700 post split at the moment. Any thoughts on tech as a sector and Tesla in particular, Rick?
It's really crazy, if you start thinking of valuations for these stocks, even the most optimistic ideas about Musk and Tesla and what they're capable of with the satellite communication system and electric cars, the expansion of the market, as optimistic as you could be, Tesla is still overpriced, I think. And the same could be said of all of the FANG stocks, that they have crazy valuations because once the portfolio managers get stuck on a theme, they just keep going with it until they beat it to death.
Right. I remember when I started on Wall Street in the early days, people were still talking about the Nifty 50. Back, I guess, in the 60s, that was a basket of stocks, including Xerox and Polaroid and names that were capturing people's imagination. Then we had the dot-com bubble burst spectacularly in 2001. And these are definitely areas that attract bubble-like valuations. But in the case of Elon Musk, he's working on that Neuralink project where he's tapping directly into your brain. It could be a new phase of propaganda where people don't mind so much what's happening in the inflationary or deflationary world because they're in Elon Musk land, living on a virtual reality farm. Is that, have you covered that, Rick, or is that not in your bailiwick?
No, I mean, we don't know, Max, for sure whether we're not already getting things beamed into our heads right now to make us do the crazy things that we do. But I think Musk is great, but even he has limits.
Yeah, true enough. And so you got this barbell approach in the portfolio, and your macros theme about kind of knocking zeros off the bond market and going into widespread default. And it won't be like Weimar Republic because they won't be able to get the cash out there fast enough. But they are coming out with central bank digital currencies. And they're going to seemingly change the way that central banks interact with the public. And they could actually be doing helicopter money directly into people's wallets, into their crypto wallets, into their digital wallets. Would that give them the ability to do the helicopter money fast enough to counterbalance the implosion in the economy, Rick?
I think the opposite would be true. When people see that capability to inflate everybody's bank account, adding a couple zeros to your checking or your savings, when they see that capability exists and the Fed's actually using it, then I'd have to admit you probably be on a hyperinflation course. Hyperinflation being kind of a state of the mind where you think, I better just buy stuff here because this money is not going to be worth anything in a week.
Right. This Chinese central bank digital currency is talking about piping money into people's wallets that has an expiration date, like frequent flyer miles that simply go bad if you don't spend them. Rick, we got to go. Thanks for your time. Thanks for being on Keiser Report.
Thank you, Max. Always a pleasure.
All right. And that's going to do it for this edition of Keiser Report with me, Max Keiser, Stacy Herbert. I'd like to thank our guest, Rick Ackerman of rickackerman.com. Check it out. Until next time. Bye, y'all.